Hey, welcome back, adventurers, investors, to another episode of Passive Income Adventures. It's the show where we want you to think more about the lifestyle that you want, how you want to live your life, and we're here to give you tools and tactics on how to help you figure out how to pay for the life that you are going for. Like my husband and I retired earlier before age 50 on real estate investing, and now we make it our business, our portfolio, to invest in other people's businesses passively and be involved in things in a more ancillary role because we feel like you need to have passive income, but having active income sometimes will smooth out irregular cash flows. Sometimes it can give you purpose and fulfillment. And part of being able to be a great passive investor is being a little bit involved in the space yourself in minor ways or becoming educated by networking in the space. So today on the show, we have Jake Clapton. He is a financial expert on commercial real estate lending and different kinds of insurance products. And so we talk a lot about risk management on the show, about how you can be better educated so that you can make better investing decisions because the less money you lose, the more money you make, right? And so Jake's going to come on and we're going to talk about just what a layperson would need to know about commercial financing, how it's so much different than our traditional like 30-year mortgage that most of us are experienced with, how it changes the risk profile of a deal. And if you have something that you want to do a commercial loan for, like maybe it's a 5 unit or a commercial building, maybe you want to buy your office space and rent out the offices as part of your retirement plan, like all sorts of things you might be bumping up against commercial real estate lending. And I don't think I realized when I first got into real estate and multifamily how different the commercial space was from the traditional, rental home and personal home loans that I had. So, Jake, we are happy to have you on here. Super excited to talk about this topic because some people think it's a little bit boring, but the more it impacts your life, the more interesting it gets. So appreciate you coming on and educating us about
No,
this.
I appreciate you having me on. It's the boring stuff that makes money,
Yeah,
not the exciting stuff. So, yeah,
that's,
I
that's
feel you.
yeah. Here. So the cleverness factor is something that usually turns me off to a deal. Is like people are trying to be clever, do this creative financing. Not that there's no place for
Oh,
that.
yeah.
Cleverness for the sake of cleverness is oftentimes like too risky for me.
Yeah, I call cleverness financial gymnastics when somebody starts pitching something to me, and it's just like, whoa, whoa, whoa! It's just no,
Yeah.
like this needs to be simpler. Don't have to do all this sophisticated stuff just to try to like put a loan together.
Yeah, it's like it either needs to be could be simplified, or if the deal is so complicated that it takes this kind of gymnastics, are you the person to take this down? Like you have to be experienced to be able to get that creative. It's not a beginner
Yeah.
moves. Um, let's just have you introduce yourself. Where you're calling in from, and give us a little bit of your background. I always want you to have a chance to tell us a little bit about yourself, some of your pivot points in your own life, what landed you here, and also like just the credibility. Like, why are you qualified to talk about what you're going to talk about? Lay it on us.
Sure. Um, So my background, I'm originally from upstate New York. And when I just a little bit further back than I was expecting, but I went to school in Buffalo and originally really was going to go in the Marine Corps as like an officer candidate. But that
Mhm.
kind of, I was going to like flight school, but when I graduated, turned out that there's like a 7-year wait list.
No.
Um, yeah. And I was like, well, what do I do now? And well, you can recruit. Or I was like, that's not good. So but a graduate economics degree. I ended up in Chicago trading interbank hedging product futures, which is basically 3-month LIBOR. So I'm kind of dating myself a little bit because LIBOR doesn't exist anymore. And then around the credit crisis in 08, 09, had an idea to start an intermediary to help people raise debt and credit for projects, various stuff, kind of all over the place. And we've been running Clopton Capital since that time. We are 100% focused on commercial real estate through
Mhm.
several different verticals. I run our finance intermediary. We're also a nationwide commercial property insurance agency. We have a buy side representation brokerage where we help source off market deals. We also run an in-house 1031 qualified intermediary. We do commercial solar installations, and we also, get into some legal services side representation as well. My day to day is still the finance side. So the deals I focus on are perm bridge construction for any commercial properties nationwide. We also are involved in the higher cap tech space, like Mez prep equity, LP equity. We also actually invest in our own book into GP equity in deals where we kind of like roll our fees into the GP side. So, we do some pretty straightforward stuff. But we also do some really complicated capital stacks as well for like different types of projects.
Mhm.
So that's really, my background in our company. Why I'm qualified. I mean, I hope at this point, after 20 something years, I can at least talk for a little bit on the subject. But I get you guys make the judgment call when we're done talking. I mean, what goes from there?
Yeah, I think it's just an opportunity for people who are like,
Sure.
I need to talk to somebody about this thing and not knowing where to go. And because
Sure.
of your specialization in the finance side, but then you also are like a hub for these other services. And so I feel like
Yep.
the organization grows, you can bring in experts to specialize in things, but yet you've got almost this quarterback opportunity to help people kind of through this entire commercial real estate space, from the financing to the insurance to even some of the equity and even a little bit of the construction from what that sounded like. But just
Right. So my thesis with all the different verticals, right? I mean, yeah, they are different products, but it really kind of came from like one day I just looked at a closing statement and I was like looking at all the different line items and I said like, I have this one piece and I focus on that and I still focus on that. Like I don't want to run too many races personally myself,
yeah.
but like I mean, especially in today's world, like all the other line items have material impact on these deals, especially, insurance is a great example. Like when I first got into commercial real estate, insurance was like just annoying, right? You just kind of like got it and you just auto renew it every year. I mean, now insurance costs have a material impact on not only values, but like serious underwriting implications, right? And like it used to be something you would just get at the closing table. Now you literally have to know what it is going in because the delta between, expectations and reality can sometimes be like 100, 200%.
Yeah.
And we flat out saved deals from being able to, have like those internal, like coordination between finance and insurance, really getting those products done like that. And like, but now we're at the point where, we'll do like a full life cycle, right? We'll source the acquisition, we'll put together the financing, the insurance, and then, when they dispose of it 5 years later, we can run it through the 1031 and just recycle the whole thing again. So it's extremely beneficial to have that type of efficiency just in-house in one location instead of a village of different corporations trying to work with each other.
Yeah, it's almost like if you're thinking about a sports team, right? You've got your head coach, but then you've got your forwards coach, you got your backs coach, and you'd have your health and conditioning coach, and all these different coaches who are really specialists at what they do. But if you don't have the head coach, then they
Right.
might be conflicting advice that people are like, wait, well, this coach told me to do this and this coach told me to do that. And there is a value in specialization, but there's also value in coordination. And so that to me is huge. And
Yeah.
I personally like to deal with people who are at the top of their space, not just like the local guy that, who's easy to access because of that coordination and that experience. And you can see something falling apart and you can be like, hey, this insurance quote or binder that you brought to us this is not going to work. Like, let's have a discussion about that. Whereas most people are just not even aware. And I've had title companies and other types of professionals kind of put deals at risk because the right hand didn't know what the left hand was doing. And
Oh,
that
100%.
was a big problem for us. Yeah.
Yeah, like here's a good example. Like I'm refinancing a Freddie, no, a Fannie loan that we did like 7 years ago or something like that. And we're in the middle of the closing process, and there's a major insurance broker on the deal. We just didn't do the insurance back then, right? And they couldn't figure it out. They literally couldn't get the right insurance after, and we're like a couple weeks from closing. And I was just like, Drew, this guy, Drew Sutton, runs our insurance agency. And I was like, Drew, can you jump in here and get the insurance? We figured it out in 5 days. And, to have that kind of ability just to like quickly delegate that type of stuff is very valuable.
Yeah. Keeps things alive. So
Hmm.
from your standpoint on the commercial finance side, some of the biggest things that I was surprised by about commercial finance when we first started getting into it, what would you say as for the layperson who's maybe an accredited investor who's seriously looking at investing in some sort of commercial real estate as a limited partner? Maybe they've already done a few, and this is where the motivation really kicks up. They put some money into something and they realize like, well, that money is there. And I actually didn't know what I was doing when I placed that money. And maybe they've done it 2 or 3 times. And now, because they're very interested, because they have money in the game, they are suddenly like, I need to get more educated about this stuff. So, what can you tell us from somebody who's never had any experience in commercial real estate, but who has had experience with mortgages, residential mortgages? What are the biggest differences between what we're used to and commercial financing?
Yeah, I mean, and I deal with this a lot, right? A lot of residential type investors call me up a lot and they want to move into commercial space to kind of get leverage on unit counts, stuff like that. Um, I think the easiest way and probably the most efficient way for them to look at it's a completely different industry. Just forget
Well,
what you know from the residential space. It's completely different.
there's no
Um,
next.
no, and okay, the biggest tip off is when I get a call and somebody says, "Hey, I need to get a pre-approval." Right there, immediately I know like there's no pre-approval, right? I mean, you put it under contract, you get your diligence period, then we put the financing together. I mean, I can have a conversation with somebody and tell them what like I think are realistic expectations. But like there's just no pre-approvals. And as you know, like you don't have a commitment in commercial until, way down the line after appraisals and credit review and all this stuff, right?
Right.
So yeah, I mean the workflow and like the process between the two industries is backwards. Like residential, you get all these upfront, financing, commitment stuff like that. That's just not the way commercial works. That's the biggest difference, right? I mean, the other is, as far as like loans, I mean, residential doesn't really balloon. You get a 30-year fixed, 30-year AM with no balloon. Commercial, totally different, right? 5, 10-year fixes, and not always a 30, right? Maybe a 20, maybe 25, maybe 30. The other aspects is, there's just so many different types of capital sources in the commercial space. I mean, when you go to residential, there's I don't know, maybe there's like a handful of lenders out there, and there's private guys, but a lot of those programs are like very uniform. When
Yeah.
you get into commercial, just off the top of my head, banks, credit unions, life cos, debt funds, private lend, right, and family, it goes on and on and on and on, and each one of those is different. Um, so I mean, it's just a completely different animal. So I tell people like, hey, it's harder to navigate. The underwriting, the credit standards are completely different. So I really, it's very hard to compare, even though they look similar, right? I mean, it is very different.
Yeah. I think the biggest thing that surprised me, the first commercial loan I went to go apply for, it's just from our like community bank. I didn't even know that there were commercial loan brokers that did this stuff. I was totally green. I kind of have the philosophy of if you want to do a deal, go do a deal. And so I went out and I went after this thing as if I was gonna, and we ended up not being able to close it because I didn't know what I was doing, right? But that first quote was like, oh, well, we can do a 5-year fixed, a 7-year fixed, or a 10-year if you put a personal guarantee on it. And I'm like, what? Like, what happens after the 5 years or the 7 years? It's fixed. Does it become an adjustable rate after that? Like, or is it like a,
Hmm.
I'm like, I'd heard of a balloon loan before, but I just remember sitting there like, this loan sucks. Like, what I was expecting, I think it was like a 14 unit building. And I just did not know what was going on. And I've seen these shorter terms, these 3-1-1. So you have 3-year fixed, then a rate bump and a rate bump. And at the end of year 5, you better have a refinance or the bank is going to put you in default. And those types of things are happening right now because we got stabilized fixed 5-year debt. Freddie Mac is specifically the property we just sold had a Freddie Mac loan on it because we were looking at the refinance terms, the rates going up so high, and we're like, this thing is not going to refi. Like, it's not going to be a performing property if we have to refinance it. And so we really needed to sell it. I think that we're going to start seeing a lot more of that coming up over the next, say, year to 2 years. People who got those stabilized loans in, say, 2021 before everything happened. And we're going to find that a lot of people are like, this property that's been in stable debt is no longer going to perform. And I think that's going to catch a lot of investors, especially limited partners who don't understand the space, like unaware that there's another round of this going, not just with the bridge debt, that those adjustable rates and rate caps that we all reached in 22 and 3 that was so devastating. But there's going to be more because these terms are
Hmm.
support and people don't understand that. So I think that those kinds of key indicators of how these commercial loans are different. But can you tell us about some of the differences that directly impact risk management for some of these more passive partners who don't play in this space?
Um, so I think the things that, if you're going into a new deal now and knowing what happened before, and I'll kind of explain what really I think the problems were before,
Mhm.
and kind of what happened and how those people got stuck. I mean, the best way I can explain it is all the property I've seen, and this is just something that's, again, very indicative of the problems is I'll see a deal that's coming up that multifamily property, it's 95% occupied, right? It's stable. There's nothing wrong with the property, but it's got debt that's coming due that is going to force some sort of crisis situation, right?
Yeah.
And what's helping is like, hey, there's not necessarily anything wrong with this property. I mean, the problem really came from, one, the type and the amount of leverage is on there, and then just the price to perfection in the leverage. So the all the deals I've seen that are having problems, had too much debt,
Mhm.
and the underwriting basically had zero margin, and the assumptions that were there was basically they were guaranteeing to themselves, rent growth and all this stuff, and expenses were going to stay exactly where they were, and there was literally just no margin, and they'd taken on so much debt. I mean, back when a lot of these deals were being put on, we were seeing 85% LTC debt, non-recourse, and, rent growth expectations that were just going expected to continue with no expense inflation.
Yeah.
As we know,
Yeah.
none of that panned out, right? Interest rates went way up. Rent growth, really stable, actually just flatlined, if not went down. And expenses went up,
A
increased
lot.
significantly because of inflation, insurance being one of those line items.
Yeah.
So, I mean, really what happened at the end of the day is, a lot of like NOI compression. But again, there's nothing necessarily wrong with, the economics of these properties and the demographics of multifamily. There's still a huge need. And, I mean, from where these properties started and rent growth, I mean, overall, the trend's been phenomenal as far as like, rent appreciation.
Mhm.
What I think, really happened, what was again, just taking on too much debt and not having any margin of error for, the underwriting assumptions.
Mhm. So
So,
if somebody's
uh,
looking at it right now because they're like, "Oh, there's distress, there are buying opportunities. If you lost money, that you have to now take advantage of the buying opportunity. Don't be scared. Don't sit on the sideline." So finish what you were gonna say and then kinda go into that, like, how people can kinda get over that feeling of, "I got burned. I was undereducated. I wanna take it.
right.
I don't know how."
The other side of it from, when people are investing with other people, not just
Mhm.
the property, but like the GP side, right? Like what profile of GP is, and what do they actually have on the hook with these deals? And if you dig into the GP structure of these, like like the general partners and what they're, what they actually have invested in these deals, a lot of, if not all of the ones I'm seeing that are in trouble, the guys have no skin in the game and not on the hook, meaning they have actually no money in the deal once you account for the acquisition fees that were charged to the properties, right?
Mhm.
And then also they're non-recourse. So
Okay.
if you have a guy that's running this ship and he has basically nothing to lose by letting this property go and or like not taking exorbitant risk, that was the other biggest issue. Because I think if you were somebody who was, in the G position, was really in a position to be held accountable for the types of decisions they were making, you wouldn't have seen a lot of that type of risk taking.
Okay. All right. So I feel like everybody blames the adjustable rate bridge debt. Should have taken that bridge debt on, should have taken a bridge debt on. But you bring up some good points. We had our insurance costs go up 100% year one and then another 100% year two in some of these high risk states like Texas, especially Florida. That was the one it was the biggest disaster. And it wasn't even in a hurricane area. It was just in Florida, um,
Hmm.
interior where it wasn't really getting that. But the insurance skyrocketed across the region. I mean, even here in Utah, I remember my daughter got her auto insurance renewal and it doubled. She's like, wait, what? How did that? It went from like $200 a month to like $400 a month. She's like, I didn't get a ticket. I was in an accident. What happened? So we called the agent. We're trying to figure out what's going on. And she goes and looks back and she's like, rates have just gone up across the board, across the country. I'm like, in Utah, we don't have hurricanes here. I was expecting this on my building in Florida. But
Yeah.
so you were talking about expense increases just due to inflation. Insurance is out of control. I feel like property taxes actually were the most predictable thing that we had, which was kind of surprising. But then we had this adjustable rate debt on top of it that you're having to the payments are going up as you're in the middle of a value add, and you're like, I don't even know how I'm going to renovate these apartments or these turnovers. People moving out because our payments so high, and we don't have enough money even from ops. You have to go raise additional money into a project that's struggling. Oh, I mean, there are just so many factors, interest rates and inflation being chief among them. So I feel like with somebody who's in that position, the money's already invested. They may or may not lose it. They may have lost them already, but others are like, I don't know if that's ever going to come back. Um, what should they be looking at in the underwriting, specifically on the financial side, to say like this is a safe loan? You mentioned LTV, LTC was a big was a loan to cost, loan to value being a low percentage. What else should they be on the lookout for?
Um, yeah, loan to cost, loan to value. That's obviously a big one, right? Like I personally, and I'm not telling anybody what they have to do, but personally, I think somewhere around like the 65-ish
Wow.
leverage debt on syndicated deals probably is a safe spot. Maybe
Okay.
70, right? I mean,
Maybe
the
so.
others,
Yeah.
what?
Yeah.
Yeah, yeah. I mean, somewhere around there. I mean, that's what I typically see, like in most LP syndicated deals. Once you get above that, again, I mean, there might be some exorbitant risk taking going on because there's not a lot of margin. On the you know on the expense side, the biggest variables I see today, again, insurance is one of those, right? But then like when I'm underwriting deals, I do, we are fact checking a lot more stuff
Mm,
and, really understanding what those expenses are going to be going forward, is really just the biggest data point here. And what I'm seeing a lot more, especially in acquisitions, is really fact checking the data that you're getting from the sellers. And one of the things that like I would probably, push as a question is, like, hey, how legitimate are the expenses that you're getting sold here and the
mm,
assumptions, right? And how fact checked are they? Like, have you actually gotten insurance quotes, right? Because what I mentioned, you can see insurance quotes today just all over the board, 100, 200% different from maybe what the expectations are. I mean, in addition, like we are some of like the GPs I'm seeing now are like really asking for bank statements from sellers to like really verify what the actual expense is, what the actual collections are, stuff like that. I mean, that
mm.
sort of fact checking is getting much, much more common. And especially I think if you're investing other people's money, that's probably, like realistic diligence that, we really need to do on these acquisitions. So,
Okay. That's surprising because when we did our very first apartment deal, we reached out to somebody we knew who did apartments. I'm like, okay, we got to do due diligence. Now what?
mm,
And they told us like every piece of paper, every bill, every lease, bank statements, tax returns, like you need every single piece of paper. If you put it on your pro forma as a line item, you better have a piece of paper to back it up
oh
because
yeah.
one, we were just guessing. The next, we're like going off what they were telling us. And he goes, and next is you need a piece of paper to back it up. Go get your insurance quotes, get your loan term sheet. Like it's like now is where the due diligence is very detail oriented and every data point has to be supported. And I was like, well, that sounds like a lot of work, but I don't know. That was our first one. So I guess I just thought everybody did it that way. But um, I mean, I just thought that
Yeah,
was
it seems like a lot of work until you own the property and then you realize, like the gas bill's double what they told you it was. And it's like, okay. Like, you mentioned insurance. So running an insurance agency, I get a lot more insight into this type of stuff. The best in you kind of said like, hey, we're in Utah. These are like low risk areas. And the what concept I don't think a lot of people realize is like think back to the Affordable Care Act when they, basically said like everybody has to have insurance, right? The high risk people they brought into the pool. The
yeah.
issue with that is the way insurance works, it has to smooth risk between all the different risk pools. So you bring in these other areas, right? And somebody's got to pay for it, right? So the low risk guys who, maybe this sounds unfair, but their insurance goes up to cover the difference in like the higher risk guys. That's what's happening in areas that are lower risk, right? So in the way insurance works, it's like a pyramid, right? I mean, it all flows up to, reinsurers and all this stuff. So the areas that are lower risk, are also getting their insurance policies
Yeah.
increased to cover the higher risk stuff.
Yeah.
Inflation and input costs, material costs. I mean, that in of itself is making insurance go higher too, right? Because the more expensive it is to repair something, to build something, the higher insurance costs got to be to make up for it.
Yeah. And when she had that happen to her, we were in the middle of a very difficult situation on that Florida property. And I was very frustrated. I remember telling her, I was like, you know what's going on here? Okay. A butterfly flapped its wings in Africa, which blew a hurricane to Florida. And so now you're paying more in Utah. And she was like,
Yeah.
okay. Yeah, that makes sense.
It may sound dramatic, but in a way, it's kind of what happened. Yeah.
We're going with hyperbole to prove a point here, but
Yeah.
you mentioned a couple other things about the skin in the game of the operator, and a lot of people are looking at that, like how much money do they have in the deal? And they don't ask, right? And they're getting an acquisition fee, which oftentimes means that they have negative money in the deal because they earn money on it.
Well,
But
I don't think, and that's a good. I don't think a lot of people realize that happens.
yeah, exactly. It's like the skin in the game. Like people would ask me, how much money are you putting into this personally? But most people didn't ask me that. And so I would tell them how much I have in, how much my other GP partners have in. When I was to our first institutional deal for its like family offices or larger funds that were looking at backing one of the buildings we were doing, and the questions they asked me, I was like, I'm learning so much from this. And we ended up not getting institutional backing on that particular project, but then we got it on a later one. I was like, wow, I learned a ton about just the questions they were asking me and the documents they were asking me for, like what I should be asking as a limited partner from these other people, like what percentage of the total raise is coming from you as the GP? And they would require us to put like the down payment down on the equity, so to speak. That's not what it's called, but you know what I mean? It's like they wanted a certain percentage coming from us, and then they would kick in a certain percentage on their side. Do we have internal management or were we using third party? And these were like their mandates. Like these are deal breakers. And they would ask me their first 3 questions and they could disqualify me because like we do not do deals with people who have not worked together on a previous deal successfully or things like that. But one thing that got me about commercial finance when I first started was like the recourse, non-recourse. And can you explain personal guarantee, recourse, non-recourse, what all of that means and what the GP is looking at as consequences for a property that forecloses when they have negative money in because they got an acquisition fee and they signed on the loan, but they don't have to pay the loan back? It's a reputational risk. If they're never going to be able to raise money again, if they lose all their investor capital, I don't know. But can you explain to us what skin they have in the game as far as the loan goes, how losing a deal or not running a deal well affects them both financially and reputationally?
Sure. I in my head, right? And actually from what I see for the most part, there's 2 main buckets of GPs out there. There's non-recourse GPs, and then there's GPs that do recourse.
Okay.
Right. And recourse loan is simple as that, right? They're personally guaranteed on the deal. Meaning if the loan goes bad, they're on the hook for the repayment of the loan personally. Right. I mean, just think about conceptually, like they're going to try a lot harder. They're much more comfortable with the deal themselves to make sure that this thing's successful and, would be less inclined to take exorbitant risk because their own money's on the line. And the other bucket, and this is what most of the deals I see that went bad are in this bucket. They're in the non-recourse loan bucket. And just, as a coincidence, the vast majority of the non-recourse bridge loan bucket I see, there was, in what you were saying was the down payment, I see as like the 90-10 or 95-5, like GP equity split. Meaning, and if somebody doesn't know, that's, let's say you need like 10 million bucks of equity for the entire thing. 90% of that 9 million would be LP equity, 10% would be GP. most of that 85% LTC bridge debt I saw out there was actually 95.5,
Oh,
right?
wow.
So like 9.5 million and 5% equity. And then if you do the math right, if you actually factor in acquisition fees, those guys actually extracted all of their money. So most of the deals that so for the most part, the guys that were in this high leverage, non-recourse bucket of capital, again, from what I saw, and a lot of those were in the 95.5 equity split camp. And then once you extracted, the acquisition fees and everything they had, they really didn't have any skin in the game. And there was, there's operators like, in between both of those
Yeah.
extremes. But again, for the deals that I saw, for the most part, that a lot of them that are having a tough time coming up were in the camp where the GPs didn't have any skin in the game, and you can just imagine why and how they were able to take like too much risk on in these deals, which is higher leverage and not having like great assumptions. So I mean, but get the difference between having recourse debt and non-recourse is really just holding, the general partners or the guys, syndicators that are putting the deals together, on the hook for repayment of the loan.
Mhm.
That's really just the difference between the two structures.
Yeah, and I don't think like recourse loans make a deal necessarily like, oh, it's recourse debt. This deal will definitely work. And the opposite true, like non-recourse, because most of the deals that I see are non-recourse, and all of my deals are non-recourse.
Sure.
At the same time, we have money in them all. So I think recourse, non-recourse is one of the risk factors. GP/LP split is another one of the factors. But each investor has to have like these family offices or institutional funds that were interviewing me had like these couple of things that were like non-starters for them. And they were all a little bit different. That was the surprising thing to me is if I made a list of like 10 of them, most funds were only asking for like maybe two or three. And so I started to see patterns come up over and over again, the more conversations I had. But at the same time, it's like not all of them had the same thing. And so I was like, okay, well, we're going to restructure the way that we take deals down to be more appealing to people who are more discerning about putting their capital out. Not that family offices are geniuses when it comes to this, right? But they're more experienced at their questions. So just kind of figuring out what that risk profile looks like, what the non-starters are for the LP. Like I will not invest in a deal that has X, Y, and Z. And it's not always because you got burned on it before either. That's the other thing is like people pack their fears. We talk about this in like the backpacking world. It's like one time when I was hiking, I couldn't find any water. And so now I always pack lots and lots of extra really heavy water. And it's like, no, that's not exactly how this is supposed to work. But becoming more educated and methodically figuring out what that risk profile is, what you're willing to say, like, I'll take one of these risk factors, but all three, I'm good. People have to kind of figure that out through
Right.
education. So is there anything else that they need to know? As
Well,
things-
I think just because you got burned on one deal doesn't mean you write off the whole industry, right? It's kind of like, investing in the stock market and, there being a downturn and selling at the bottom, be like, I'm out, and then watching it come all the way back, right? I mean, you kind of miss the upside. And like the industry, like, with the way, rates ran up at the highest pace in history. Um,
Crazy.
yeah, yeah. So I mean, yeah, I wouldn't. I mean, think about it. Like now we're on the reset, and the things are going to come back up. So if you invested at basically the top and you feel like you got burned and you're writing up the whole industry, that you could, past performance is not indicative of future success, right? So I mean, now is really the time to get into it.
Yep.
Exactly. The qualifications that you're mentioning, my best guess is are you vertically integrated with management? Are you nearby the property? Right. I mean, is it an off market deal? Do you have your own money invested? Stuff like that. I mean, those are all, oh, and like, have you worked together? Right. Because like a lot of the institutional investors, if it's a new team, they consider it a startup.
Yeah.
Um, so, and especially like those are important things to pay attention to, right? One thing that I do see a lot is like in people's bios and experience, and this is one thing to dig into. It's like, how many deals have you done in the past? And I'll see like, oh, I've done billions of dollars, blah, blah, blah. And I'm like, okay, but how many have you done it as sponsors? Like, well, I did them all working at this company. Big difference,
Wild
right?
flat. Yep.
Big difference. It's the best way I can analogize it is, somebody who worked for a construction company and I've just built all this stuff versus now I'm the developer, I'm the GC. You know
Yeah.
what I mean?
Yeah.
That's
Oh,
that's a
wow, my
that's a
partner.
big difference.
I mean, I feel like the experience
Yeah,
at the development company was valuable, but I
for
certainly
sure.
say, well, this guy's done this before. It's like the more similar what they're doing is to what they've already done, the better. So yes, working in a development company is relevant experience, but it's not experience, not
It's
for the
not running the whole ship. There's just so much. I mean, you know how just running a business. There's just so much more to doing this. Like for what I do than just arranging loans. Like it's just there's 200 times more. And I mean, like a good part of my day is dealing with like the other side of it and not actually arranging. You know what I mean? So when you're on the hook and you're like the sponsor, it's a totally different deal than just working as an acquisition guy at some real estate company.
Yeah, huge, huge, huge difference. Really important questions to be asking. And I think I would just kind of urge the listener. I think if you're even listening to the show, you obviously haven't completely written off like commercial real estate or even multifamily. I'm not telling anybody to invest in multifamily. The last multifamily property I invested in was in 2021. So I've been out of the game for a little while now on the acquisition side. I'm still managing. We just sold some stuff. We did buy an RV park in 2023 or like December 23. So 2024, we bought an RV park. So it's not like I'm completely out of the game. But I'm watching, I'm listening, I'm educating myself because it is people are like, oh, it's different this time. And it's never really different. But it is also in the details different. So I feel like the more I'm educating myself, networking with you, as I like people kind of listening in as we network and I'm educating myself, because I do feel like my experience as a multifamily syndicator will make me a much better limited partner at doing due diligence on
Sure.
deals and retired, and I will be able to place money with more confidence and more carefully. These things are just so important. So the listener obviously is still interested and in the position where they're like, I just want to do a better job this time around. So you sharing your experience is it's so valuable. And again, that quarterback head coach thing you have going with a deep network of hundreds of banks and institutions you work with to get loans, like this is the kind of person that you want. These are the kinds of questions you ask the people you're working with. Like, how many banks are you going to shop? Do you know insurance people? Like, the network is so valuable, which is why we even put these shows on, because now we're in your network. You can call us. Like, how do people get a hold of you, Jake, if they want to say, hey, I got some questions?
Yeah, I am exceptionally easy to get a hold of. You can just go to our website, cloptoncapital.com, or hit me up on LinkedIn. I've got to be easy. I have like 30,000 connections to me. And then like, I'm sure my phone number is out there and as well as my email address. So I'm very, very easy to get in touch.
Okay, perfect. And I think that if you're going to describe like your ideal client, I mean, sometimes we're talking about the ideal client the whole way through, but usually at the end, I will ask like, who should reach out to you after the show? Describe what somebody who needs your help typically looks like.
Yeah, I mean, the people that typically reach out to me that we're able to service, right, is like owners and operators of commercial real estate. So like a lot of the GP syndicators you're mentioning, like we work with those guys to help arrange loans. If there's an LP out there that wants guidance, and to try to like maybe just figure something out, give me a shot. I'm more than happy to chat. Or if anybody on the insurance side or something like that. So if you're driving deals or purchasing deals, absolutely, reach out and get in touch.
Okay. And I also find having people like you in my network is useful when I have capital that I need to place. And I'm like,
Sure.
hey, that's some, and you can't make referrals. You're not a certified financial planner, but you can make careful introductions. I'm even careful about the introductions that I make for this kind of stuff because there's a tax for introducing people if things don't go well. So I'm not saying you're going to introduce people to capital, but I definitely feel like just putting the word out to people who are well networked and well connected, like that I'm going to have a capital event coming up. I need some capital to place. You got your ear to the ground on anything. And
Sure.
but you're not just going to give that to a stranger, is my point. It's like, this is where networking becomes so valuable, and actually keeping up on relationships and having legitimate conversations with people so that you can reach out and just say, I'm letting a few people know I got this. And, you know, I'll just leave that there. You know what I mean? I don't know. What do you thoughts on
Yeah, we'll be we're actually going to be raising project level LP funds
that?
because I mean again we our ears to the ground, right? We have very deep proprietary deal flow and then all the data point and all the different input costs and finance insurance and all this stuff. So I mean, yeah, I mean, if there's people with capital events coming up later this year, we're going to have, direct line of investability for stuff like that.
Okay, perfect. Yes, when it's an LP situation and you're set up as a security, it changes. You can more safely make introductions and
Oh,
recommendations.
yes.
Yeah, so because you have some of your own skin in the game when it's your own fund. So yeah, great information. I think that you have. I mean, we could probably talk for years on this kind of stuff and pick your brain on every single detail. But I think this is a good little primer. If people want to reach out to you, cloptoncapital.com, Jake Clapton on LinkedIn, and you can get a hold of me easily at investwithemma.com. And I encourage you to do so. You are not bothering us. Like, we go on these podcasts so we can talk to you. So be sure to reach out after the show. Anybody you want to be introduced to, I'm happy to kind of point you to anybody who's been on this show before, but it is not a recommendation or endorsement of any guest who's been on the show. It's not financial advice, additional purpose only. So thank you so much for coming on the show, Jay.
Thank you.
All right.
Appreciate
And
it.
I'll see all of you next week for our next passive income adventure so that we can help you figure out how to pay for your adventures. Have a good one.